Our next guest is telling his clients to brace for a pullback, and he warns the Nasdaq could drop 10% in the coming months. Let's bring in Julian Emanuel, Chief Equity and Derivative Strategist at BTIG. Julian, great to see you. What's going to trigger this correction in the Nasdaq?
There are a number of things. First off, we've gotten a lot of questions over the last week or two. Is this a bubble? Is this not a bubble? What I would first say is valuation-wise, it is not a bubble. And when you look at the Nasdaq and you look at FANG in particular, what you see is the kind of earnings growth and momentum and obviously free cash flow that would lead you to indicate that it isn't a bubble. But however, what you've got now is a record concentration in 5 names. And if you look at today, the Nasdaq 5 was really the Nasdaq 1. But at 23% of the weight of the S&P 500 index, when momentum in those names has clearly slowed, we do think that essentially continued tension with China is the most likely catalyst for a pullback in those names.
Yeah, Julian, I know this is Nasdaq specific, but in terms of the S&P 500, you say it's not a bubble. Obviously, everybody's entitled to their opinion. But one thing I would point out, in terms of market cap to GDP, you're talking about the S&P 500 somewhere between now 165, 170% to GDP, and the numerator continues to go higher, and the denominator, which is GDP, continues to go lower. How sustainable is that? Because that's the one thing that Warren Buffett looks at as his indication of where the market is.
Well, Guy, there's no question that that is a concern. And obviously, when you think about the sort of the economic backdrop, it makes it even more important that the reopening of the economy that we're expecting in the fall and going into early next year is a success. And clearly, a lot of the stocks, and particularly in recent days, the value names are starting to reflect the greater probability of that as a success. I think that is still to be seen. And I think, obviously, one of the issues surrounding all of these questions is where stimulus negotiations go. From our point of view, the belief that people had a week ago that you were going to get a package before the September jobs report on the 4th of September of $1 trillion to $1.5 trillion. From our point of view, we think that the market still believes that, and we'll just have to see. But again, the threat to the economy, to the downside, certainly does stress that relationship.
Hey, Julian, it's Tim. When we were younger men, yes, that's right. You and I both invested a lot in the commodity space, in the resources space, in emerging markets. If anything, we're starting to see some pronounced breaking out of some of those resource stocks, industrial names that have a lot of global commodity exposure. Some of this is dollar-based. Some of this are PMIs are getting better. Some of this is that stimulus that is in the other parts of the world. What do you do with this trade? Because I feel like we've seen this movie before, and it's a pretty good movie.
So I think you hold on to it for the long term, because ultimately a weaker dollar is part and parcel of a recovering global economy. However, what I would say is that particularly as surrounds the stimulus negotiations, there is this sort of idea that politicians, surprisingly, don't want to spend infinitely. And obviously, that's a lot of the pushback of the last several days. And so from our point of view, when you look at record bearish positioning in the dollar, we do think you get a dollar reflex rally. And we don't think it's any coincidence that the dollar was stronger today. At the same time, the Nasdaq, one of the bigger momentum trades, was weaker, and gold itself was really choppy. But long term, you want to stay with that theme.
Julian, how much longer in your view? I mean, it sounds like not much longer in your view, but, there's this notion that there is no alternative. And Karen has mentioned this regarding her own portfolio. But basically, if you're saying that there's going to be a pullback and you're recommending that people brace for this, we're basically saying that the liquidity train of the Fed can't keep this market going higher. Is that your belief?
That's correct, Melissa. Basically, if you think about what the Fed has done, they have basically engineered liquidity. But to move from liquidity to solvency, which is basically requires an economic rebound that really is only showing tentative signs of occurring right now, That's the story for, how the economy is hopefully going to unfold into next year. And that's what keeps stocks moving forward. But the Fed hasn't run out of bullets. It's just the effectiveness of those bullets is likely diminishing while we wait for the economy to turn higher.